Let's bring in Barry Knapp, Director of Research at Ironsides Macro. Barry, it's good to have you. I was just looking at some data David Beckworth was passing around, suggesting that the economy is way above potential right now in terms of growth. I mean, what accounts for this?
Well, when you think about the aggregate policy setting, the fiscal policy setting has never been easier. So if you're, in an industry where you're reliant on rebuilding our infrastructure, the green energy build out, transfer payments to individuals as a percent of disposable income are 110 basis points above where they were pre-pandemic. So that end of the income strata is benefiting. If you finance further out the curve, which Steve's been talking about all morning, you're a large corporate or even a large bank, you're benefiting from the effect of the Fed's balance sheet. This is something that I've been talking about since they started the process. Dave Zervos has also discussed this at length about the accommodation that the balance sheet's providing. But listen, Steve absolutely nailed it with his reports. One of the first things I heard when I turned on CNBC this morning, that the small business sector is bearing the brunt of the burden of tighter Fed policy. The passive QT after very aggressive QE and aggressive rate hikes caused the deepest curve inversion since the Volcker era. That bankrupted the savings and loan industry, which at the time was 80% of the supply of mortgage credit. And it's having a similarly, rough impact on the small business sector, which happens to be the sector that we have the least amount of information on. We just don't get good stats.
We know it's the engine of high, but Barry, if we back out and say, no matter, we don't have a lot of information on that sector. All we know from a very top level is the economy seems to be doing quite well right now, perhaps even accelerating. Look at what's going on in the market. Is it telling you that we're actually, the cyclicals are doing well, some of the industrials, even the small caps lately? I mean, it seems to us almost like we're at the beginning of another cycle or something, and the stock market is at all-time highs, and none of this seems to be the kind of environment in which we should be talking about Fed rate cuts.
Well, I disagree with that. I think they should be cutting rates, but I would absolutely, unequivocally be against them stopping QT. So I think that they need to, and not only should they not stop QT, they should start shortening the duration in their portfolio back towards the front end, towards bills, and allow the long-term rates to be set by the markets. Diminish that influence they're having. That would disinvert the curve, take all the pressure off small banks and small businesses, but raise the cost of capital for large corporates if indeed that needs to be slowed down. So, this is my nuance with respect to what Feroli said and Livornia said, which is I'm not so much thinking that they shouldn't get to 4%, which is as far as I think they need to go on the policy rate, but I unequivocally want them to continue with QT as long as they can, and then start shortening the duration of that portfolio so that they put upward pressure on long-term rates and make conditions a little tighter for the large corporates. So, we don't have a reacceleration of growth.
Kind of like another kind of twist. But I look, your point would exactly help to fix what might be ailing this economy. Put a little more pressure on people who, big, wealthy, can tap the bond markets, take the pressure off the small businesses borrowing at those floating rates. Steve, it seems crazy, but if Barry and others are saying the rate only needs to get to 4% and we're at 4.8 right now, how do we know? Maybe we're at neutral.
We don't, Kelly. And I like to fish and wade in streams, and this is a bit like when you're wading in the stream and the water is dark and you're feeling with your feet for the bottom. Is that rock loose? Is that mud? I don't know. Am I gonna slip and fall in the stream here? I think that's the way the Fed is doing it, kind of like groping around blindly in the dark to try to find it. I think 4 is a good place to stop and look around, but you got to get there first. And I think we have two things, Kelly. We've given not enough credit for how much credit has eased in the economy and how it might be benefiting now from that, which is not a permanent effect, but it does have a certain impact on GDP right now. It's been a year or so since credit has been easing. That's one. Two is the idea of the difference between the experience of Main Street and Wall Street. And you're right. Main Street is a big engine of growth, a big engine of job growth. And it just strikes me, Kelly, that the difference between Main Street and Wall Street, we think is geography. But you can also think of it as access to capital, right? Main Street has to go on its knees and crawl to the bank. Wall Street is kind of like pulled by the investment banks into the capital markets, which are very hungry for yield right now.
Very.
So I just think those are very different outcomes. And if you don't take care of both sides, well, then you're risking poor economic outcomes.